Guys, these are 5 stocks on my 30 stock list that you can buy today at today's prices and potentially get a market-beating return over the next 10 years. Let's break them down one by one. First stock, Nike. I'm wearing some LeBrons right now. Nike is at $100 a share. It hit an all-time high of $175 on November 5th, 2021. Over 2 years ago, still hasn't reached that high. They have some aggressive ambitions for the future. Here are their 8 pillars. Now, guys, these beautiful 8 pillars right here, there's 6 of them. And if you've watched our channel before, these 2 valuation metrics are our only X's. What does that mean? Well, it means we're just basically waiting for the price to fall. Remember, a great company at the wrong price is not a good investment. The question is this the wrong price? Well, we don't know. This is a very stable company, a big moat, but does it have a lot of growth potential? I don't know about that. But every other metric we see cash flow, it's gone up $2.9 billion in the last 5 years. Net income is up $700 million in the last 5 years. Revenue growth up $10.7 billion in the last 5 years. They're buying back a few shares. They have a really great return on invested capital. What's that? It means that they get a good return on the money that's invested in the business. This is a sign of your moat. So, what is the right price for Nike? Can it beat the market? Let's go take a look at Nike on our stock analyzer tool. I just pulled it up right before we did this. I'm doing a 10-year analysis right here. And on our software, you can do 1 to 20. Here are my assumptions that I did. 5, 8, 11% revenue growth. Now, the reason I went with 8, analysts are expecting about 8% revenue growth. And I think with inflation, that's a pretty solid sign. Now, I've actually increased my profit margin. Why? Nike's starting to do more direct to consumer, which is higher margin. That's very important for Nike. If they can do more direct to consumer, they're going to generate a higher profit because they don't have to sell wholesale to somebody else. So I did go higher on my profit margin and my free cash flow margin. I did both at 10, 11.5, and 13%. Now, what's the PE I want to assign to Nike at the end of 10 years? Well, I chose 17, 20, and 23 for both PE and price to free cash flow. Now, when I talk about market-beating returns, and I'll explain this in just a few minutes, but over history, the market gets about 9 or 10%. I actually think the next 10 years are going to be much worse than that. So 9% return here could beat the market. There's obviously going to be volatility. I hit the analyze button. The stock's currently at 100.74. And if you're willing to go with the ups and downs of the market, 64 is a low price, 164 is a high price, 104 in the middle. Again, this is not going to be a straight line. This is going to be a lot of ups and downs. If we all of a sudden have a bear market that's bad, Nike will definitely fall with it. So you have to be ready to buy at lower prices. You're never going to buy at the bottom. I cannot stress this enough. This is not going to be a straight line up for any company. There will be volatility along the way. The question is, if you are able to understand that when you buy a stock, you're buying a piece of a business and you can ignore Mr. Market, you can do very well owning a great company at a great price. Company number 2, Starbucks. Guys, Starbucks is incredible. They're growing a lot. They're still growing like crazy. They are closing some stores up, but this is a business that women love. Look at this consistent profit margin. 11% over the last 5 years and 11.5% in the last year. Very, very consistent. You've got free cash flow, $3.7 billion last year versus 4.12. You've got a very high return on invested capital. 57% over the last 5 years. Let's check out the 8 pillars. My guess is it's going to look a lot like, okay, so the only difference between this and Nike is a lot more debt. But can Starbucks support that? They're retail locations. They have leases to pay. I'm okay with this debt level for a company like Starbucks. But again, price to free cash flow right here and 5-year PE are both X's. But again, it might not be the issue here. Let's see what analysts are saying for Starbucks long-term growth. I mean, they're looking at double-digit revenue growth for the next 5 years. So let's see what we have in our stock analyzer tool. All right, guys, so I did another 10-year analysis. I did 6, 8, and 10% revenue growth. It was actually a little bit lower than analysts are thinking over the next 5 years. So I did it for 10 years. I did profit margin of 10, 11, and 12. I actually think I was too conservative there. I might bump that up to 10, 11.5, and 13%. Because if you look, they actually did pretty close to that over here. And hopefully they become a lot more efficient in their operations and growth. So they could be able to get that 13+%. What PE did I put in? I put 17.5, 20, 22.5 for both the ending PE, and the ending price to free cash flow. And again, my 9% return. The stock is currently at 91.86. We hit the analyze button. Guys, I got a low price of 66, high price of 138, a middle price of 97. So let me explain what these numbers mean. If the middle assumptions occur, you can get your over 9% return at the stock price up to $96. If you pay today's price of $91.84, you'll make about 9.6%. This is based on a free cash flow basis. It's not based on the markets being rational, okay? If the high assumptions occur, paying today's price, you can make 14.5%. So on this company, on Nike, and on the next three, it all depends on what assumptions you're making. Anytime we buy a stock, you decide what are your assumptions you're making. Now, before we get into the next three stocks, by the way, three stocks that I personally currently own, let me explain to you what I mean by market beating average. Currently, I believe the stock market is very overpriced. Every week in our community, I announce the stock market to GDP ratio as well as the 10-year cyclically adjusted PE ratio, which in very simple form takes the last 10 years of profit in the S&P, brings it to today with inflation, and divides the market cap by there to see how over or underpriced it is, okay? Now, with that said, we are currently 87% overvalued when it comes to the stock market to GDP ratio. Stock to GDP. When it comes to the 10-year cyclically adjusted PE ratio, we're 89% overvalued. And this is going back to 1929. Now, are there arguments as to why these are too high? Of course there are. There's always going to be arguments. Remember, news follows stock prices, not the other way around. So when things are going very well, they're going to be telling you this is why these are misleading. And when things are bad, they're going to tell you, when I'm sitting there saying, hey, the prices are very low, this is great, people are going to say, this is what you're not getting. The world's coming to an end. This and this is happening. Just remember about the pits of COVID. People were saying the world's never going to come back from this. Nobody's going to work in an office ever again. Cruise lines are done. Travel's done. Did that happen? There are record revenues on airlines right now. So I look at this saying, guys, based on this and based on history, we're looking at a negative return. Negative 3.4%, I believe, return on the S&P over the next 10 years, not including dividends. And remember, this is based on data that I've just pulled going back to 1929. Could it be different this time? Sure. But as we all know, those are the four most dangerous words in investing. So that's what I mean by 9% would crush negative 3.4. But remember, the stock price probably won't do 9% because of the fact that when markets go down, pretty much everybody goes down. So let's get to the next three stocks, all of which I own. Generac. Now, guys, I started a small position in Generac. I got very lucky, bought it at a very low price, and then it skyrocketed. And I'm hoping, and that actually bothers me. Now, you might be sitting there, if you're new to the channel, going, it bothers you? The stock went up? It bothers me. I don't want to pay more for a company. I want to pay less. I was hoping it was the start of another down market for Generac. After all, Generac hit a high of $524 back on November 2nd, 2021. It is currently at $113 from $524 2 years ago. That's incredible. So, going to the 8 pillars, we look right here. A few more X's. They got net income falling. But ironically, cash flow is up. So cash flow is up $32 million in the last 5 years, while net income is down $95 million. And if you look and compare it right here, this is one thing I do like. Generac is the leading generator company. I love them. I'm getting a Generac system put in my house very shortly. These guys were probably running up because everybody's putting money in their houses, building was booming, and then it's collapsed since then. I believe Generac is a company that'll be around for a very, very long time. And that's why I get excited when the stock goes down, because I don't think the stock is going to zero. Now, is there a little bit more debt than I'd like? Of course. That is more debt, 8 times their 5-year free cash flow, which means they have about $1.7 billion in debt. But they did $4 billion in revenue. Not bad. Not bad at all. Okay, so let's see what analysts are saying. And again, they're just analysts. But analysts are expecting some good growth in their earnings per share from $7.46 this year to $12.50 in 2028. But analysts were also the people that expected Tesla to make $7.50 last year per share, and they ended up making a lot less. And revenue growth, high single digits, high single digit revenue growth. So as long, again, whenever you buy a stock, if you're not able to see it go up and down, you should just stick to ETFs. So let's see what our stock analyzer tool is saying about this company. So guys, again, 10-year analysis. My revenue growth assumptions are 4, 7.5, and 11%, which is a little bit lower than their 5-year growth assumptions according to analysts. Profit margin, I did 9.5, 10.5, and 11.5 across the board for profit margin and free cash flow. As you can see, they had a lot less profit and free cash flow in the last 12 months, but that could be just short term. PE, I did 15, 18, and 21. Same here. Now look at their current PE, 43, and their current price of free cash flow, 33.6. Well, it's also because their profit and free cash flow was about half of what it was in the last 10 years. So that's something to consider here. And again, I did my 9% annual return. Hit the analyze button. Guys, this is incredible. You're going to love this. I have a low price of 100, a high price of 260, middle price of 163. Remember, guys, this assumes no margin of safety. Every single stock we've done so far, margin of safety is kind of like where you put your buffer. So if you're trying to make the market return of 9%, there's not much buffer there. So I'm personally not buying at this price. But at the same point, I want to wait for things to get a little bit rosier for me, which means the stock price falling. Stock number 4, Southwest Airlines. Now, guys, I will tell you, I own the stock and I have it based on one play and one play only. Look at this profit margin. 2% in the last year, 2.2% in the last 5 years. However, let's go to our income statement and see what it was before COVID. Right before COVID, in 2019, they did $22.4 billion in revenue. What was their profit? 2.44, over 10%. Let's see what they did in 2018. They did $21.5 billion in revenue with profit of $3.5 billion. That's 15%. 2017, $20.8 billion in revenue with $2 billion in profit, another 10%. Do you see my point here? I think that the current profit margin is way lower than it should be historically. I think they should be in the around 10% profit margin. So if we apply that today, look at their revenue in the last 12 months. In the last 12 months, they've done $25.4 billion, which should be $2.5 billion in profit. $2.5 billion in profit. Assuming, by the way, now that their market cap is $19.7 billion, that's less than 8 times PE based on their average profit margin before COVID. And remember, they did 15%. And some of the years where they made 10, 11%, that was during that whole 737 MAX issue where they lost $870 million in 1 year just because of that. So I do think that Southwest has potential to do higher than 10% profit margin. It's a very tough business, the airline industry. But Southwest, I believe, is the best operator in that business. They stick to the same planes, they stick to more manageable routes, and they don't try to compete with all the big dogs in that regard. So I'm comfortable with that. Now, let's go to our stock analyzer tool and see where we stand for Southwest. All right, guys. So again, 10-year assumptions. I did 2, 4, and 6% revenue growth, which is pretty reasonable. I didn't think anything too crazy. For my profit margin, I did a low side of 7%. Middle of 10, high side of 13, same with free cash flow. PE of 15, 18, and 21. Again, the same for price of free cash flow and my 9% returns. And again, guys, the numbers you're going to see below don't include any sort of margin of safety, but it might be built in there because the current price is 30 and I have my low price of close to 40, my high price of 122, my middle price of 73. Okay, so my play is that the profit margin will end up going back to normal levels. If that happens, I think I'm going to do very well on Southwest Airlines. But again, don't buy it just because I own it and just because anybody else owns it. Buy it because you feel comfortable with the thesis and you can stomach seeing the stock fall tremendously. Final stock, guys. We all know this one. The Googly Moogly, Google. Phenomenal balance sheet, very little debt on hand. They own the world of search. They own the world of online advertising. What else do I need to say about this bad mamma jamma? Guys, the only 2 X's here are our price to free cash flow and PE ratio. The question you have to ask yourself here is, what's the right price to pay for Google? Because I think Google is going to be around for a long time. It's going to increase in its... I think I love about Google is when they sell ads, they charge you less as long as the user experience is better. So you could be the number one placed ad, but you might be paying less than the number 2 or 3 ad, because as long as the user has a better experience and they're getting to what they want better with you, they're going to charge you less money. What an amazing world is that. And they own the 2 top search engines in the world, Google and this very thing you're on right now, YouTube. So let's go pull up Google and our stock analyzer tool. All right, guys. So our stock analyzer tool, I did 5, 8, and 11% revenue growth, which is significantly lower than the last 5 and 10 years. I did profit margin of 22, 24, and 26. Same thing for free cash flow. PE. Look at this. I did a higher PE because I just think it's going to be hard. They have a great balance sheet. They've got a great brand. They're going to stick around for a long time. I stuck with those 20, 23, and 26 and 9% return. Hit the analyze button. The stock's currently at 154. And I have a low price of 109, a high price of 250, a middle price of 166. So guys, if you like these tools and you want to use it to help you get better at investing and to understand this world, along with our community, everythingmoney.com, free 7-day full access trial, the entire website, 7 days for free. Go check it out.